Okay, dear student, let's start pre-seen mock, December 25, question number 2. And the remaining two questions we'll be inshallah discussing on coming Sunday. Let's read the requirement A. Based on hedging strategies, Shechem company is considering recommended a hedging strategy for the 35 million investment if interest rate are expected to decrease by 0.7%. So definitely when they're talking about investment and there's a risk of fall in the interest rate, so it is good enough for us to decide that we are heading towards a question which is actually about lending. Because depositor, they have the risk that interest rate could fall. I'm also happy in one thing. Then look at this. Examiner has given us that interest rate is expected to decrease by 0.7%. Of course, when I'm a depositor, then I face the risk of decrease in the deposit interest rate. I do not face the risk of rise in the interest rate. In the past papers, sometimes examiner gives us both the movements, but logically, there should be one movement. If it is a scenario of deposit, then it should be logically one movement that is a risk for me, and that movement is fall in the interest rate. If I'm a borrower, logically I face one risk, and that risk is rise in the interest rate. So I'm very happy that only one risk which actually depositor faces, examiner has mentioned that. 14 marks, then 6 marks we have got. Critically evaluate the views of each of 3 directors regarding Shekem's risk management strategy. How many directors? 3, 6 marks. So logically 2 marks per director. Critically evaluate. So whatever one director is saying, you have to critically evaluate. You have to bring more meanings to what that particular director has said. Then the 5 marks. Professional marks will be awarded for the demonstration of a skill analysis and evaluation. I always say this means you should know the data very well. The way you are solving the question, it automatically tells the marker that either you know the data or not. Then is skepticism. If, for example, if I'm making any assumption, then you can, of course, bring some skepticism to that assumption. Commercial acumen, if there are more than one strategies available for interest rate hedge, so obviously I will opt logically the one in case of deposit which gives me higher annual interest rate. So let's read the question. Oh, just a minute. The following exhibits available on the left hand side: transaction information, director hedging information, director's opinion. Okay. It is now 1st December X5. The date is very important, students. Examiner says it is now 1st December X5. Today is 1st December X5. Shechem Company is a large multinational clothes manufacturer specializing in women's fashion, having recently signed a deal to provide garments to a well-known high street retailer. Shechem is expecting to receive 35 million on 1st March X6. Stop. Today's date is 1st December X5. Shechem company is expecting to receive 35 million on 1st March X6. 6. If we count the months, so December complete, the whole month of December, whole month of Jan, the whole month of Fab. Can I say exactly after 3 months, Shechem company will receive 35 million? Is that clear to everyone? Logically, 1st March X6 is the date you are receiving this 35 million, which will be invested until it is needed to purchase further material on 1st September X6. On 1st March, they will be receiving 35 million. Then they will be investing that 35 million. Can I say for next 6 months, if you count the time period, from March, I'll count the time till 31st August. Logically, they will be depositing from 1st March X6 to 1st September X6. So deposit time period is 6 months. Okay. Reports in the media suggest interest rates are likely to fluctuate significantly in the coming months. As a result, Shekem's treasury team has advised management to consider hedging against the adverse rate movements using either interest rate futures or options on interest rate futures. Two hedging strategies are there. One is either to go for future or options. But look at this. This something important is written. Shekem treasury team. You have got a whole team. Has advised the management to consider hedging against adverse rate movement. Obviously, we are the depositor, and for us, the adverse rate movement will be fall in the deposit rate. The current central bank rate is 3.5%. You can say current LIBOR is 3.5. Okay. Shekem can invest funds at the relevant central bank rate less 30 basis points. I have said many times in my regular lectures also that actually when we will be writing the actual result, only then we will consider these less 30 basis points. In case of borrowing, examiner says you can borrow at LIBOR plus. So basically, when do we deal with CRP, credit risk premium? We deal with the CRP when we are writing actual results. Other than that, we are not going to consider this credit risk premium because we are not hedging this credit risk premium. We are hedging the movement in the interest rate, which is we are hedging the adverse movement in the LIBOR rate, let's say. Several media reports predict that rates could decrease by as much as 0.7% over the coming months. Based on advice from Treasury team, Shekem's board are considering the following 3 risk management strategies. How many? 3 risk management strategies. Strategy 1. Wow, 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 wow. Do no hedge. Wow. Shekem would not hedge the transaction and instead deposit funds at the spot rate on the date the money is received. There's one strategy is there's no need of risk. I would say logic doesn't look, I would say, how to put in words, doesn't look, I would say, logical at all. Because if you, there's no need to write, doesn't look sensible, that does not sound good. So it is not logical at all when you are saying no need to hedge. Why it is not logical? See, you are a depositor, you are facing a risk that interest rate could fall, and examiner has mentioned in the question that there is a chance of fall in the interest rate by 0.7%. And you are saying that let's go for no hedging. So it's not logical. Let's see. The second strategy, interest rate futures. The following information and quotes are provided from an appropriate exchange dollar future. Margin requirements can be ignored. Okay. We have got 3 months contract size is 1 million. Prices are quoted 100 minus annual yield. December X5, March, June. Then option, just a minute, just a minute. Look at this. It can be assumed that settlement for the future and options contract is at the end of the month and the basis diminishes to zero at contract maturity at a constant rate. Based on monthly time interval, assume there is no basis risk. We know the technical meaning of there is no basis risk means whatever future closeout rate will you calculate, it means when the day comes, on that day the rate will be same. That is the meaning of there is no basis risk. But still you will be calculating basis and dealing with that. My question is, student, three future contracts are available: December, March and June, and contract will mature at the end of the month. So which future contract will you opt? Three are available. Let's see the answer. Let's see. March is perfect. March is just perfect. And I want to say something. Logically, the March contract will mature on 31st March. Am I right? March contract will mature on 31st March. But we will actually close this contract, can I say, on 1st March? Because the transaction day, the day when we are going to deposit the amount, that is 1st March. Contract will mature on 31st March. We will close the contract on 1st March. Logically, 1 month before expiry, we will actually 1 month before maturity, we will close the contract. So logically, unused basis will be of 1 month. Is that clear to everyone? We will have unused basis, but only 1 month. Unused basis 1 month. Okay. Options, will come to that, don't worry at all. Three of Shekem's senior directors have different opinions on how to manage upcoming investment. Can I say whatever the director A, B, and C they are saying that deals to the requirement B, it does not deal with requirement A. Am I right? So we will be reading it, don't worry at all. But right now, let's deal with that. Part A, there are three strategies. What was the strategy number one? Strategy one, do no, do no hedge. Strategy one, do no hedge. Now, please try to understand, if you are not hedging, which is mentioned in strategy one, they are saying whatever will be the interest rate on that day, we will deposit the 35 million for next 6 months on that rate. Now, listen. Right now, the LIBOR is 3.5%. Central bank rate is 3.5. Interest rate will fall by 0.7%. Logically, on transaction date, your LIBOR will be, your central bank base rate will be 2.8%. Is that clear to everyone? First of all, on transaction date, your central bank rate will be 2.8%. Is that clear? First, please reply to me. On 1st March. Yes, thank you. Central bank base rate will be 2.8%. That is 3.5 minus 0.7. Okay. So what is the name of that company? I think it was Shecum Company. will deposit at, can I say 2.8 minus the 30 basis point? They will be depositing at 2.5%. Is that clear? Let me write now actual interest income. 35 million they will be investing at 2.5% for 6 months. So 35 million. Student, I am getting 4,37,500. Without hedging, Shakam company will receive, you can say, interest income of 4,37,500 in the bracket annual effective interest rate. I strongly believe strategy number 1 is crystal clear to everyone. I think I've already, okay, let's go back. It is mentioned here. Can you read this kindly? The current central bank rate is 3.5. Shakam company can invest funds at the relevant central bank rate less what? 30 basis point. Is that clear? Okay. Now let's go for the second strategy, which is interest rate future. Interest rate future. The student, it is mentioned, we have already decided which future we will take. March, yes or no, please reply. Because transaction date is 1st March, so obviously we will go for March future. We have already decided. Contract date. That is simply, we are going for 31st March future. Now hedging strategy. Now listen and listen carefully. In case of deposit, the strategy is buy now, sell later. So sell later, if you are writing, that is not important. The main important point is what you are doing initially. Deposit, the strategy is buy now. So can I say the hedging strategy is buy March futures. Is that clear? In case of borrowing, the strategy is sell now, buy later. Deposit, the strategy is buy March futures. Okay, now number of contracts. Amount need to deposit is 35 million. Contract size is 1 million into time period of lending, which is 6 months, divided by 3. We know that this 3 is pure fact, which actually shows from one contract to another contract, the difference is the time period is 3 months, which I have already explained in my regular classes. So can I say the number of contracts I'm getting 70? Please check. Students, number of contracts I'm getting 70. Kindly reply and use your calculator. Yes or no, please. You can tell me. Okay, next point. Another question. Another question. Okay. Let's do the strategy 2 on a spreadsheet. There's no issue at all. Same thing we'll be doing it. Just a minute. There's a request from the students that we should be doing strategy 2 on the spreadsheet. So we can do that. Just a minute. No issue at all. Even the strategy 1 you could have done. Okay. There's a request on. I hope you can see that. We are solving part A first. Let's go with the strategy 1. Strategy 1, do no hedge. If you're not hedging, so can I say whatever will be the spot rate, annual interest rate on 1st March minus 30 basis point final, whatever the interest rate comes on that interest rate, we will deposit 35 million for how many months? 6 months. So simply interest rate on 1st March. I'm writing 2.8%. How did I get this? I'll show my examiner 3.5 minus 0.7 bracket close. Okay. Then actual deposit rate will be 2.5%. How did I get this 2.5? That is 2.8. Can I say minus 0.3? Okay. So actual interest income at 2.5%. Let me take it here. It's 35 million if I'm not wrong. Just a minute, there's 6 zeros. Okay. Multiply by 2.5%. Then 6 by 12. So we're getting 4,37,500. So under strategy 1, what is the name of the company? Shekam. Just a minute. Shekam company will receive 4,37,500 in 6 months time at an annual effective rate of 2.5%. Now let's go for strategy 2. That is interest rate futures. Interest rate futures. Okay. Let's say which contract we have already decided. 31st March future. Then hedging strategy. Can I say buy 31st March futures? Then it was number of contracts. I'll take 35 million divided by 1 million multiply by time period of deposit is 6 divided by 3. So number of contracts, there are 70. I hope it is clear to everyone. Now one more thing. Examiner has not given us the tick value. So we can very easily calculate tick value. Tick value. Students 1 million multiply by 1 upon 10,000 multiply by 3 upon 12. Tick value is 25. Now let's calculate basis risk. We'll take spot rate. How to calculate spot rate? Can I say 100 minus today's LIBOR, which is 3.5. Then future rate. Student, you can see that they have given us the future rate 96.80. Future rate they have given us 96.80. I hope it is clear to everyone. See the basis. Basis is the difference between future rate and spot rate. But don't forget the trend. Look at the trend. Trend says future rate is more than the spot rate. Okay? Keep that in your mind. Without minding it, please. So it is mentioned in the question that basis will reduce gradually. Now, today's date is 1st December. Try to understand. The day we are starting the hedging, that date is 1st December X5. Transaction date is 1st March. From 1st December, if I go till 1st March, it is 3 months. But contract will mature on 31st March. So can I say logically this basis is a basis of 4 months. And we will close this contract 1 month before the maturity. So we will have unused basis of 1 month. Unused basis of, let's say, 1 month. How will you calculate? I'll take this. Multiply by 1 upon 4. So unused basis is of 1 month. I hope till here everything is clear. Kindly reply, please. Till here everything is clear. Please reply. Okay, it's clear. Unused basis is of 1 month. Now let's calculate future closeout rate. So simply you can say outcomes of future hedge. But first we need to calculate future closeout rate. How will you calculate? Can I say spot rate? On 1st March, X6. Can I say logically spot rate on 1st March X6 will be Let me just write here. When interest rate falls by 0.7%. So just in the bracket, I'm telling my examiner 3.5 minus 0.7. Okay. Spot rate. Can I say 100 minus 2.8? So we are getting spotted on 1st March X6 97.2. Now look at the trend of in day one. We have already decided whatever the trend comes in day one, you will not violate that trend. If you look at the day one, spot rate is 96.5, future is 96.8. Can I say future is more than a spot? So the day we are calculating future closeout rate, on that day also, future rate will be more than spot rate. So student, what should I do with the unused basis? Should I add or should I deduct? Can I say add unused basis? So here comes future closeout rate. I hope it is clear. That's great. Now, let's, where's the what? Now we can simply show actual interest income and what is happening in the future market. Let me now first write actual interest income. Even you can copy paste, there's no harm at all. It's 35 million, I think 10 more. We will be investing at 2.5 into 6 by 12. Now, student, please, what is our strategy? The strategy is buy now, sell later. Now, try to understand. Actually, we bought the future at 96.8. We bought the future at 96.8 and we'll be selling future at 97.275. I can see there's a gain on futures. Why? Because the selling rate is higher than the buying rate. Student, please check. We bought futures at 96.8. We are selling them at 97.275. Logically, the selling rate is more than the buying rate, so there is a gain on future. Can I say gain on future will actually increase your overall interest income? So simply add let's see any question. Okay, it's clear. Please look at this. Add gain on futures. We are selling them at this price. We are buying them. We bought them at this price. If you recall the formula, selling minus buying multiply by 100, then multiply by number of contracts, then multiply by tick value, which is 25. We multiply this with 100 so that we can get basis points. Then we multiply this with 70 because the number of contracts which are involved, they are 70. Then into tick value, let's see what we are getting. Student, the gain on future I'm getting 83,125. So total income, this plus this. Annual effective interest rate. We'll take this divided by, can I say 35 million? Then multiply by 12 upon 6. Then whatever comes into 100. So actually we are getting annual effective interest rate 2. We are getting annual effective interest rate 2.975%, which is of course more than if we are not hedging, because if we are not hedging, then effective rate is 2.5%. So you can say that under future hedge, company will get total interest income of 520625. I hope till here everything is clear. Yes or no? Please reply. Students. Okay. Now let's come to the question. Student, now let's read the option part. The following information and quotes are provided from an appropriate exchange. So, of course, few things are very clear to us. We'll go for call option in case of deposit. Date will be March. There's no doubt about it. So let's strategy 3. Strategy 3 is options on futures. That is our strategy 3. Okay. Now let's go for, simply I'm just directly writing the hedging strategy. Can I simply buy March call option? Buy March call options. Is that clear? Yes or no? Please reply, students. Buy March call options. Now, interestingly, we have got two exercise prices. Now, logically, we have to decide one price out of two. How to decide? Again, we know that we will opt the exercise price which will give us higher annual interest rate. So, okay, let's write exercise price. It's a deposit scenario, so the next column will be floor percentage. Then, of course, we have to pay the premium. So, premium percentage. Then we will have annual return. Exercise price, examiner has given us 96.40. The second one is, let's say, 97. How to calculate floor? It's very simple. 100 minus this. 100 minus this. Premium. Examiner has given us 0.560 and the second premium is 0.315. Now student, listen and listen carefully. We are dealing with a scenario of deposit. Can I say by paying premium, return will reduce? Yes or no? Please reply. By paying premium, your annual return, let me put the percentage, will reduce. Yes or no? Please reply. Your annual return percentage will fall. So this minus the premium. This minus the premium. In case of borrowing, what do? We add the premium percentage. Premium actually increases the ceiling percentage. Premium increases the borrowing cost. But in case of deposit, premium reduce your return. Now, student, there are two annual return in front of us. One is 3.04%, another is 2.685. So which one will you opt? Which exercise price will you opt? Can I say the exercise price which gives us a higher return? We will opt that one. Yes or no? Please reply. Shakam company will work on exercise price 96.4 due to higher return than other exercise price. I hope till here it is clear. Why we are going for 96.4, it is clear. We are giving the reason to our examiner as well. Now student, very easily we can calculate outcomes, everything. Let's calculate outcomes of hedge. Actual interest income. Student, I'm just doing this. We can do that. Okay, we have to show the examiner one more step, that are we exercising the option or not. Let me show you that step first. Just a minute. Exercise price is 96.5 and we have got call. Call means right to buy. We will compare this exercise price with future closeout price. We will compare this exercise price with future closeout price. Future closeout price, and let's see where is the future closeout price. Student, future closeout rate is this. Student, exercise price, we have got call. Call means right to buy. Now try to understand. Shakam company can buy at 96.4. Then they can sell at 97.275. Can I say we will exercise the option? Is that clear, students? Option will be exercise. We have got call. Call means right to buy. Shakam company can buy at 96.4, then they will be selling at 97.275. So obviously they will exercise the option. Now you can go for actual interest income. Where was the actual interest income? Is here. Can I say due to gain on options, again your return will increase. Add gain on options. Shakam company will be selling at this price. They have bought at this. Multiply by 100 so that we can get gain in basis points. Then multiply by 70. Number of contracts are 70 into tick value. Student, the gain amount I'm getting is 1,53,125, but story does not stop here. Can I say we have to pay the premium? And premium is your outflow. Again, the premium will reduce your overall return. So less premium payment. Premium is 0.560 into 100 into 70 into 25. Student, premium amount I'm getting is 98,000. Here comes your total income. You can use some formula. There is no harm at all. Annual effective rate. One more zero into, we are annualizing it, so 12 upon 6, then into 100. Let me just write here annual effective rate. Student, we are getting 2.815%. I hope that strategy 1, 2, 3 all are clear. Kindly reply, please. All the strategies, they should be clear to you. Okay. And student, that is also in my pre-recorded classes as well. Whenever exam, again, if you recall, I did mention one thing in my classes also. Can I say practically two exercise prices are not possible? What was the reason, student? I have given the reason also why practically two exercise prices are not possible. Can I say Shakam company practically cannot go for two exercise prices? Give me the reason, student. Why? Why I'm saying this? Can you please answer? Okay, let's see what the students are saying. Yes, otherwise they will be paying premium twice. Who will pay the premium twice? It makes no sense to keep two exercise prices in your hand. You will be end up by paying premium twice. So obviously it is not logical at all. So practically there will be one exercise price. So whenever examiner gives you two exercise price, you need to logically decide one out of these two. And it can be clearly seen. I think future is better than everyone. All the strategies, okay. If you go based on the hedging strategies, is considered recommend a hedging strategy, 35 million investment. So can I say recommendation can I say simply interest rate futures are recommendable? Due to giving higher return as compared to options. You can say as compared to other strategies. So interest rate futures are recommendable due to giving higher returns as compared to other strategies. Of course, it's a very short recommendation. If you don't have time in exam, write like this. Otherwise, how to write the recommendation, I have properly explained that. Let me tell you, how will you write the recommendation? You are not supposed to write the recommendation like that. First, you will be putting a proper heading of interest rate future, then simply you will be explaining your examiner. The logically interest rate future will fix the annual return for you. Number one, it will fix the return for you. Second, you will say your examiner fixed annual return will make planning easier for the company. Third, you will say your examiner that futures, they are providing higher return than other strategies. That is why future are recommendable. Then you will go for options as well. And then simply you will say that options are not recommendable because first you will say that options, they are flexible, they provide choices, but options are not recommendable because they are expensive due to premium payment. Okay. So I've given you how to write a proper strategy. Now the main part is part B, critically evaluate the views of each of the three directors. Let's see. Student, I'm just opening now this complete PDF. Just a minute. I hope you can see the complete PDF. Please reply so that we can critically evaluate director A, B, C. Please reply. But student, how to write the recommendation, I have already explained in my regular classes. Okay? And I've just given you the idea as well. Okay. Now let's see director A, what he says. Director A is of the opinion over several years, sometimes interest rate will move in our favor. Sometimes they will not, they will work against us. Can say till here everything is correct. Director is of the opinion over several years. Sometimes interest rates will move in our favor. Sometimes they will work against us. It all cancels out. Hedging takes up too much time and efforts to worthwhile. We should be willing to accept the risk of any changes in the interest rate without hedging. Director A, and whatever Director A has said, we have to critically evaluate. First of all, we will say that Director A is correct. As far as what Director A is saying, that of course over a period of time interest rate will increase and it will also reduce, impact will cancel out. Till here Director A is correct. But after that Director A is saying hedging takes up too much time and effort to be worthwhile. Now, hedging takes too much time. Just a minute. Why director is thinking like this? Director is saying it will take too much time. It means all the top level management, they will be involved in hedging, and who will look after the business, other areas. So let me reply Director A. Come here. Director A is forgetting one thing. And what Director A is forgetting? Look at this. Shakem Ganni's treasury team has advised. Now stop. Director is, I think, forgetting one thing, that Shakem company has got a complete treasury team. Then what is the work of treasury team if they are not doing even hedging, if they don't have the time for the hedging? So if I have got a treasury team, so simply treasury team will look after this hedging work. Of course, there will be so many other directors and so many others, I would say, top level, they are sitting in the management, they will be looking after other works in the business. So director is, I think, forgetting that they have Shakem company is having a treasury team. All you needed, this is the work of treasury team. So can I say this point is not acceptable, that when you are saying it will take too much time. So basically director is not doing himself. Who will do that? Treasury team. So basically this is the work of treasury team, and rest of the work will be done by others. Another point, we should be willing to accept the risk of changes in the interest rate without hedging. Actually, number one, what is the answer for the too much time and effort? We said that answer is you have got treasury team for hedging. No issue at all. Second point, director A says we should be willing to accept the risk of any changes in the interest rate without hedging. So technically, logically, We should not be willing to accept the risk of any changes in the interest rate without hedging. Why? Because if due to hedging, I can reduce my risks, so why not? Why should I put my company in a situation where I have to face risk? So basically, without hedging, there's a possibility of losing a really high return, because director is forgetting one more point. We are not investing just few thousands. Students, the amount which we will be depositing, that is 35 million. Just try to understand. It's a really big amount, and we will be not investing this 35 million for 1 day or 2 days. We'll be investing this for 6 months. Even the few basis point interest rate which I can, interest income which I can generate with hedging, so I should go for that. So where we agreed with the director A, in the first part we agreed with the director A, but when director A said this, it will take too much time, so we said Shekam company has got treasury team, they will look after hedging stuff. Another point, we will not accept that. Of course, no hedging means you will be facing a greater risk, and you are forgetting one point. You are not depositing a very small amount, you'll be depositing a 35 million. Is that clear, student, how to evaluate critically what director A has said? Please reply on that. Students, I'm just waiting. Director B favors using futures and claims that futures are preferred as they will guarantee the interest rate Shekam will receive in the future. Now stop. Till here again we agree. Why we agree? Logically, what happens basically in case of interest rate future, actually interest rate technically becomes fixed for you. Then either the LIBOR increases or decreases, you will get the same interest rate. Okay. This means we can focus on the core business, fine, and not have to worry about interest rate changes. We also don't need any cash up front like we would if we use. Now here he's making a mistake. Director B, I think, is forgetting one thing, which is requirement of initial margin deposit. Student, if you recall, either it is a currency future or interest rate future, you have to deposit initial margin. Then we know that practically on daily basis, either there will be gain or loss. If that margin amount reduces, it goes below the maintenance level margin, then you have to top up. So basically, when director B says favors using futures and that futures are perfect, we can also put little bit emphasis on perfect as well. So we can say that to a certain extent, director is correct that future will lock the interest rate for the company. Okay. Either the LIBOR increases or decreases, the rate will remain same theoretically. Then you can also put one more thing, that practically we cannot say futures are perfect. Perfect, I've just seen now. Why? Can I say company practically they do face basis risk? Practically you do face basis risk. Due to basis risk, whatever annual effective interest rate we have calculated, practically it will be different. So at least we cannot say perfect. Another point which director B has highlighted here, that there's no need any cash up. Can I say initial margin deposit is required? Is that clear, student? How to evaluate critically what director B says. Now let's see the director C. Would prefer to use options. Wow. As looking at the future prices, it seems that media reports would be wrong. We want to be able to benefit from higher interest if rates go up. I know options are extremely expensive, but this will be more than repaid if rates do what? Increase. Now look at this, director C. Director C would prefer to use options as looking at the future prices. It seems that media reports would be wrong. We want to be able to benefit from higher interest rate if rates goes up. Now student, listen carefully. Number one, then make okay, when rates goes up, you will be getting a, because first of all, again we said, if the interest rate goes up, then obviously under options we will have the choice either to exercise the option or not. For example, if interest rate goes up and let's say if I lapse the option, it is a beneficial part for me, I can do that. So till here, director is correct. If interest rate goes up and you are having the option, again you can choose the benefit. You can choose the option which give, you can opt the scenario which gives you the benefit. If by lapsing the option it is beneficial for me, I can do that, but I cannot do this in future. But director C, technically I would say missing one part. What is that part? Try to understand. Let's assume media report is wrong. And instead of fall in the interest rate, let's assume for a minute that interest rate actually will definitely increase. Can I say, if you are so sure that interest rate will actually increase and media reports they are all wrong, I think then there's no need for hedging. Why? Because we are depositor, we are lenders, and we face only one risk, and the risk is fall in the interest rate. Rise in the interest rate is not my risk at all. Try to understand, students, what I want to say. If you are a lender and someone has given you the information, don't worry at all that interest rate will actually increase. No need. Then why would I do anything? Because if the interest rate will actually increase, then for me, the beneficial strategy will be that I should not be doing anything. Because even the interest rate increases and I have the option, still I have to pay the premium. Student, are you getting this point? How to evaluate director C? And let me tell you one more thing. It is, if you have any other logical point in your mind which makes sense, you can write that also, provided that it should make sense. You will get marks. Now let me share the answer of this pre-seen mock. Let's see what they have written. This is my critical thinking regarding what A, B, and C says. Let me pause this, save this, and share the answer. Okay, look at this, student. Strategy 1, do nothing. I think we got the same result. Future, it was same. Option, I think it was same also. What we recommended futures. Future provide the highest return and so should be chosen. But I have all in my regular classes, student, I have properly explained you how to write the conclusion. Now let's come here. I hope we got the same results. I want to see one thing. Student, look at this. Annual return percentage, we calculated the same. Look at this. Therefore, choose what? I did mention in my regular classes also, try to work on one exercise price. There's no need to work on two exercise prices. I hope you can see that here. Premium, this. Okay. Wow. Then they're working on second price also. Look at this, student. Thank God. They have written something very nice. Full working were not required for both exercise prices if students had justified why they had chosen one rate or the other previously. Is that clear, student? This is what I have been telling you in my regular classes also. When examiner gives you two prices, then logically you are deciding one price that is good enough. So thank God, finally there is a justification also which you can see in the pre-seen mock. So always need to work on one price, but you have to give the justification. Let's see what director A says and what we were saying. This director A, this director is correct. in that on some occasions rate changes will work in Shekham's favor and sometimes will work against. However, this is a high risk strategy, especially with the investment of, it's not 38, I think it is 35, maybe printing error, such as upcoming amounts of Shekham is expected. If rates do fall, Shechem could miss out around 100,000 of interest by not hedging. I think they were, if you are not hedging, what was the amount? The amount was 4 lakh 37,500. And future, what was the amount? So almost examiner has just taken the difference. This was the gain on futures. So almost you will be losing 1 lakh. They also said hedging takes up too much time and effort. Some products do require initially arranging monitoring, but Shechem only has what? Dedicated treasury team who should be used to do this and deal with it so the directors can still focus on their core business decision. I think we were also thinking more or less in the same way. Director B is right that future will provide some certainty around the interest and Shechem will receive. However, the amount is not guaranteed. Perfect, you cannot say, and future are not perfect. This is the problem. The amount 520.6 is only an estimate as it assumes that basis reduces to zero at constant rate and there is no basis. But practically basis risk company will face. They also said futures won't need any cash upfront. However, in reality, futures do require margin deposit upfront. Whilst these are often small compared to the option premium, Shechem will still require some cash to be available for the deposit and potential margin top-ups. I think we were saying more or less the same things. Let's see, Director C is right. To point out the trend in the future prices, prices are decreasing, which suggests that rates will rise. When interest rate increases, then future rates will reduce. If this is the case, option would indeed be wise choice as Shechem could abandon the option, see, which we were discussing. If actually you have the option and interest rate increases, then you can lapse the option and take the advantage of better rates. They said option in this case are extremely expensive, which isn't always. In this current deal, the premium is 98,000, which whilst still a sizable amount is relatively small as compared to the deposit. Why? I don't know why they're writing 38 million. I think we were doing with 35. But they did not write one thing which we have pointed out, that if the media reports are actually wrong and you are so sure that interest rate will actually rise, see, interest rate will rise, then you are going to abandon the option. You will not be exercising the option. So simply what I have mentioned, if you are so sure that media reports are wrong and interest rate will rise, then I think we should not be doing hedging at all. That will be the best strategy. So student, I strongly believe each and every thing regarding this question is clear to everyone. Please reply before we end today's class. Remaining two questions, inshallah, we'll be discussing in the coming Sunday class, but I would request before that, please, you people should attempt remaining two questions of the pre-seen mock. Plus, it is highly advisable that every one of you must attempt ASA mock. I think within couple of days, admin will tell you the timings and everything. If within time you are going to attempt and submit ASA mock to us, then I'm going to personally check your mock and I'm going to personally give you the feedback. But in order to get a personalized feedback, you have to attempt and submit within a available timings, which admin will tell you. And the mock will be exactly on CB platform. You will get the same simulation, same environment which you will be facing in your real exam. So that is all about today's class, student. In the coming Sunday, we'll be inshallah discussing the remaining two questions of the pre-seen mock. Student, if you have any questions, my WhatsApp is available. You can ask there, please. You can ask the question on WhatsApp. So student, any question regarding any study, you can always ask on WhatsApp. No issue at all. So students, that is all about today's class. Please, if you have any queries, do ask in your relevant WhatsApp group. I'm going to personally reply. Don't worry at all. Thank you very much.